years of business leadership.
Five, four, three, two, one.
Fabulous experience it really has been for all of us here at CNBC-TV18 to chronicle India's story.
Asset allocation is key. It was important yesterday, it is important today, it will be important tomorrow.
When we hear about this 10-year, 20-year bull run in India, and everything looks like a Ram Rajya, at that time we have to be little cautious.
Real estate is about location, location, location. Equity markets are about earnings, earnings, earnings.
And so many new businesses we have not even thought about are getting conceptualized, and the spirit of entrepreneurship.
Hello and welcome to CNBC TV18. You're with us here on a very special edition of Markets Today. I am Prashant. With me, my colleague Sonia Shenoy. Sonia, hi.
What a day, right? I mean, big day for CNBC TV18. Not so much for the market, but lots to talk about. These are all the top headlines, and we have a big guest joining us as well. In case you missed out on the day, the RBI's Monetary Policy Committee hiked the benchmark repo rates by 35 basis points as expected, decided to remain focused on withdrawal of accommodation. The repo rate is now at the highest level in more than 5 years. Today's hike is also the lowest in the rate hiking cycle.
Stock markets see some wild swings. Sensex and Nifty end in the red after RBI's rate hike. Rupee gains almost against the dollar, but remains above the 82 to a dollar mark.
And oil prices continue to trade low after falling to its lowest levels yesterday. Since September, economic uncertainty and the prospects of higher interest rates weigh on prices. Well, the top story this evening, the RBI's Monetary Policy Committee has hiked rates by 35 basis points, which marks the central bank's fifth consecutive rate hike this year. The repo rate now stands at 6.25%, which is the highest since August 2018. However, the MPC's stance remains focused on withdrawal of accommodation while supporting growth. Meanwhile, the Reserve Bank has cut the GDP growth forecast but retained its inflation forecast for FY23. The governor, while addressing the media, said that the central bank was committed to prevent excessive volatility in the exchange rate and believes that the worst of inflation was behind us.
With regard to inflation, I would like to say that the worst of inflation is behind us. I think this point needs to be taken note of. The worst of inflation is behind us. While inflation is moderating, and while we recognize and we state that the worst of inflation is behind us, but there is no room for complacency. We have to be extremely watchful, and we'll have to be nimble in our actions. We have to watchful, and we have to act should it become necessary. We are ready to undertake liquidity operations to inject liquidity, but we will look for durable signs of a turn in the liquidity cycle. The story of Indian rupee is one of resilience and stability, and we remain committed to act to prevent excessive volatility of our exchange rate, and our focus will continue to be on orderly evolution of the exchange rate.
Okay, that is the RBI governor. Let's take this conversation forward. Timothy Moe is Chief Asia Pacific Strategist at Goldman Sachs, and he's joining us now to take some questions. Tim, great to have you with us here. Appreciate your time here on CNBC TV18. Prashant this side. You know, that was the RBI governor saying that we have, and he said that twice over, that we've seen the worst of inflation. About maybe a little over 10 days back, you put out a note in which you said, without the comfort of depressed valuations for markets to do well, we need to see the peak in inflation. So that remains, I'm assuming, to your mind, the big call for equities as we head into 2023. So let's just start there. What do you think? Have we seen the worst of inflation, worst of high yields, or not yet?
Well, we may have seen the worst of inflation, but we think, maybe following on Director Das's comments, that we are expecting 2 more 25 basis point hikes for the RBI to have a peak repo rate of 6.75%. So we still think there's a little bit further tightening that we have to go, even if the sort of inflation is crested, there still needs to be further tightening of monetary policy in order to make sure that inflation continues to subside. And if I could just extend that comment one point further, I think you mentioned in your question that there's an issue with valuations if we get straight to the equity market. We are very, very optimistic about the prospects fundamentally in terms of growth and in terms of earnings and so forth, in absolute terms and also in comparison to other markets in the region. But the valuations are elevated just given India's tremendous success in terms of how the equity market is done. So that plus further increases in rates suggests that it may be challenging for India to continue to outperform to the same extent that it did this year. Hence our market weighting within a regional context.
Okay. Tim, thank you for joining us on CNBC-TV18. You know, I was going through your note where you are bullish on India's long-term prospects, but you're wary of high valuations. And that seems to be the concern, not just particularly to India, but even if you compare it to peers like, say, China or other emerging markets. In that context, what would the ideal strategy be for an equity market investor here in India for 2023?
Well, there's a lot to unpack there, Motilal. And first of all, I want to say thank you so much for having me on the show. It's a great honor, particularly at this auspicious celebratory time. So I just want to first express my tremendous thanks for being able to join and add hopefully something to the conversation. But getting straight to it, I'd say that I really want to differentiate our views. I guess in a simple context, we could say that the longer-term strategic prospects for India and for the Indian stock market, we think are actually among the best, if not the best, in Asia. Just to give a couple of numbers here, our long-term view on GDP growth for India at 6% or a bit above is one of the highest, if not the highest, in the region. You asked about China, and our longer-term view there is more like 4% GDP growth and probably maybe some downward pressure there. So I think there's a gap opening up between the potential growth rates for these two very large and very populous economies. Now, in terms of how the market's done and how things are priced, that's where things get a little bit more challenging for equity investors because, of course, equity markets are about both the fundamentals, but also about how much is priced into them. And in India's case, the fundamentals are excellent. We have 15% EPS growth for this coming year and for 2024 as well. And that compound 15% growth is actually among the highest that we will see in the region. We're actually looking for declines in parts of North Asia next year in 2023. Because of their greater reliance on the global, sort of the greater global cyclicality and sensitivity, and also very high concentration in the semiconductor space. And then there'll be a strong recovery in 2024, we think, but the compound growth will certainly be somewhat lower than what we're expecting for India. So I think on a fundamental basis, from earnings standpoint, India is really one of the leaders. That being said, there's also a question of how much you're paying for that. And here I think that the nod has to go towards some of the North Asian markets, particularly China and Korea. And just to give, again, a bit of enumeration of this, India is currently trading in round numbers at about 22 times forward earnings. That's at the very high end of its 20-year valuation range. It was at a 90% premium to the region, with China having rallied in November. That premium has come down, but it's still at the high end of its longer-term range at about 70%. So both in absolute and relative terms, and the third thing we can throw in is relative to domestic interest rates, also the market is looking on the stretch side. So it doesn't mean we're bearish, far from it, but we just think that it may be tougher for India to outperform to the same very significant extent that it did in 2022 in the year to come. Just the final point I'd make, in contrast to that, in China's case, China having fallen so far, and even with a very robust recovery of actually the best month in November since July of 1999, so that's nearly 25 years ago, we had the best month in just this past month. We still think that coming off a very low level where China at its lows was at 8.7 times forward earnings. Now we're about 10 to 10.5 times earnings, but we still think there's some further upside to fair valuation, plus some earnings recovery. So we still think there's further to go for China equities. That's why we're overweight there, at least to begin the year. Maybe I'll pause there. I'm sure there's lots more we can dig into.
How significant is that? I mean, so well, as you said, longer term, you're very bullish on India, but valuations maybe in the short term are a bit of a problem. On those same lines, I mean, if I were to ask you about China, Is it the opposite there? Tactically, because valuations are very cheap. Short term, medium term, maybe expect bounces, but longer run there are issues there. I mean, the property market and other issues politically as well. I mean, I don't know if you have a view. Tim, go on.
Well, Prashant, we have a lot of views on this, and we can dig into this a bit. So there are at least 2 or 3 key points we'd like to enumerate. The first is that having fallen very substantially, we do think that Chinese equities are undervalued, and with the clear and emerging catalyst of a reopening from the self-imposed zero COVID policy, which has suppressed growth this year to about 3%, is what our full year 2022 GDP forecast is. We think that China, as it gradually reopens, and our timing, by the way, for when reopening takes place will be, we think it will really kick into gear in the second quarter of next year for some reasons I can describe if you wish. But the key point is we think that growth in the early part of 2023 will be somewhat suppressed as you go through some of the challenges. When you reopen, you tend to get an increase in cases and maybe some suppression of economic activity. But the second half we think will actually be quite robust. And overall, we think China's GDP growth will accelerate to a full year number of about 4.5% next year. And that'll also drive a pickup in earnings, which have been suppressed this year. We actually think earnings will probably be flat to down 2% this year for China. And next year, we're below consensus, but still think we'll see a recovery to about 8% EPS growth, and then maybe some further increase into 2024. As I mentioned just a few moments ago, the offshore stocks, the aggregate MSCI China index, valuations fell to about 8.7 times at the low. They've since recovered, given that very sharp recovery that we've seen for the market in November, to about 10.5 times. But even accounting for some geopolitical risk, which I'll mention in just a moment, we think fair value for the China market, offshore market, is about 11 times earnings. So the point is that we still think we can see some moderate valuation expansion. Perhaps there could be some overshoot to that, and also some recovery in earnings. And the combination of those two can give us, we think, still sort of 15 to possibly even 20% upside from current levels, especially if the market corrects a bit of its rally in November, which it did today. Offshore stocks are down about 3% today. So that's really kind of the argument for the offshore stocks. I do want to take just a moment, if I may, to clarify that we have quite different views in terms of the onshore China stocks, which are the so-called A shares, versus the offshore China stocks, which are colloquially known as the H shares. The H shares, which I was just describing, we think have a very good recovery potential, but there are some challenges to your question going forward. Number one is there is some uncertainty about the degree of profits that private-owned enterprises will be allowed or encouraged to produce. So in our recent reports, we've done some analysis which assesses the extent to which private-owned enterprise returns on equity may converge to those of the state-owned enterprise. Cutting through all the analysis, the punchline is that we think that overall the POE, private enterprise returns on equity, may converge to the SOE one, state-owned enterprises, which is about 12%. So that's kind of suggests that perhaps the longer-term growth potential may be somewhat less than it has been before. And then secondly, in terms of valuation, we've actually formally introduced into our valuation models a geopolitical risk element. We have some statistical support for doing so, and the end result of that is that we have lowered our fair value for the Indian equity market, for the China equity market, from 12 times earnings to 11 times. And that's how we get our offshore expectations. The final point I want to make is that we have a much more stronger strategic view on the onshore so-called A shares. And the reason there is that a lot more of them are in the industries that are supported by government policy. And if there's one cardinal rule for investing in China, it is that you want to follow and be aligned with what the government policy is indicating. Without going into too much detail, there are certain policies which are very clear and have been enumerated by President Xi in the last 10 years, and we think will still remain in effect. Those include the common prosperity theme, the theme of dual circulation, the theme of technology upgrading, the theme of import substitution. And we find that many of the stocks that are in the A-share market are aligned with that. And indeed, one of our favorite themes is the theme of the so-called little giants, which are small to mid-cap companies in the hard technology space that have the overt backing of the government in terms of driving their innovation. So that's really kind of our view on China. And that suggests that, to your question, to wrap this up, that for the offshore stocks, it's a bit more of a tactical overweight that we have. We think that there's a good recovery driven by the reopening. But if the market runs up too far, then we would perhaps be inclined to moderate some of the view there and then rotate elsewhere where there may be clearer longer-term growth opportunities, including India.
In fact, we want to take that discussion forward about how you're approaching the Indian markets. Let's slip into a short break. But before we do that, let's leave you with some commentary that we received through the course of the day. We'll come back.
We were all expecting a 35 odd basis points increase in the repo rate. I remember in the interview after the last policy, my view was that we would see another 35 basis points rise. I think the governor has kept the door open for a possible small hike in the next policy, possible. That is perhaps will emanate out depending on the data that comes through. And the data will also depend to a great extent on global events, what Fed does and so many other things. But generally speaking, I think we've reached almost the peak of the interest rate cycle. So at most, I repeat, 20-25 basis points hike in rates in the next policy, but then there will, to my mind, be a clear stop thereafter.
You will see a tempering of the advantage that the banks have got in the next couple of quarters, because on one side, the interest rates have been hiked and we have got the benefit of it. But on the other side, the deposit rates are slowly catching up. If you look at the wholesale deposits, the rates have already gone up by close to 300 basis points. But on the term deposit rates, the hikes have been lower. But as they get repriced with all these hikes on the repo rate side by the RBI, I think the cost of funds will keep going up, and it will not be that easy to continue to pass on this increase in cost of deposits on the lending side. So my view is that NIMs could come under pressure in the next couple of quarters for the industry. I think most of the industry players are clearly hinting at that also.
The cost of financing is going up, definitely, but relative to what Indian corporates can raise overseas, still it is very attractive to raise money in the Indian markets. So Indian interest rates, even though have gone up, but as far as the access to, on a relative basis, to domestic markets is attractive. That is why the cost of financing has gone up, but I don't think because of which any company will hold the capex, because the long-term story of India is very encouraging.
CNBC-TV18, celebrating 23 years of business leadership.
Welcome back to this very special edition of Markets Today. We're celebrating 23 years here at CNBC-TV18, and we continue our conversation with Timothy Moore of Goldman Sachs, who's been telling us about his strategy for the new year. Tim, before the break, you were talking to us about how you're bullish on India's long-term prospects, but you're a little wary about valuations. In terms of individual sectors or pockets of interest, where do you see both valuation as well as growth headroom, particularly for India?
Well, within the market, we've got some very clear views, which we've expressed in a recent report. Just to single out a few things, we're very much encouraged on the banks. There's just we think, a terrific story, and our bank analyst in Mumbai, Rahul Jain, has been very clear about his views there. I think the key story is that we are seeing clearly a recovery in private credit issuance and private credit demand. The increase in rates that we've seen, which obviously has been discussed today, suggests that margins are still have some potential to expand. And additionally, we are at the early stage of any sort of a credit cycle, so we're not at all worried about significant write-offs. So it's a pretty powerful combination of opportunities, we think, for the banks. So we're certainly very favorable there. On the insurance sector, we have also significant positive views, and then I'd say that we have a broader positive view on the industrial cyclicals, again, because of this recovery in investment and the need for continued investment in India. So we think there's lots of opportunity at the more micro level when you start to drill down into the different sectors and the different themes.
Okay, and cement would be a part of that? I mean, you like that space as well?
Absolutely.
Yeah.
I didn't want to enumerate everything, but definitely cement is there, and we've reaffirmed that. I was just in Mumbai last week. We had our India Chief Investment Officer conference there, and spent time with our analysts and with various business leaders, and certainly that cement, all part of that supply chain for infrastructure investment and development, we think is generally looks very attractive.
Another space which Goldman has coverage on, at least a few names, is these new age. Maybe not all of them are platform companies, but names like Paytm. There is Policy Bazaar, which is PB FinTech. Companies which have come to the listed space a year and a half ago, all are down between 50 and 70%. Any thoughts? I mean, valuations have come off. We were looking at valuations and where they're trading compared to some of their global peers, listed both in China and the US. In many cases, valuations have come off. Any thoughts, Tim, there?
Absolutely, Prashant. And I think you've really hit the nail on the head in that we have to separate between the fundamental growth outlook versus the valuation. And I think it's fair to say that the private sector valuations for many of these digital companies which have been developed, and India has produced the greatest number of unicorns in the private sector space, I believe, of any economy. We did a big report on that about a year or so ago, and at that point, India had developed 60 unicorns, and that number swelled to close to 100 subsequently. So I think that there was kind of a gold rush which took place in the private sector, and some of the companies naturally got to elevated valuations, particularly in an environment of low interest rates. Now, obviously, with interest rates rising globally, we've seen the so-called long duration part of the market come off, and that would very much include some of these more early stage startup companies which are being valued on their future growth prospects. So when rates go up and your discount rate increases, then that tends to put greater pressure on those so-called long duration assets. And India was no different than what we've seen in, say, the US or other areas where that sort of high growth and sometimes not yet profitable growth part of the market came under significant pressure. So fast forward to today, when, as you said, we've had significant decline in valuation, I think that suggests there's an opportunity to re-engage in the still very encouraging fundamental growth story.
Okay, and one final question. You have pointed out to some risks in the near term, some cyclical issues in the Indian markets, whether it's higher inflation, whether it's RBI policy hikes and a weaker rupee as well. Do you think these are enough to derail the Indian equity markets, or will the resilience continue despite all of these headwinds?
In a word, Motilal, I think the resilience continues. I think these are just sort of headwinds or speed bumps along the way, but we don't think that they will deflect India from either fundamentally growing or the equity market from still having a very favorable longer-term prospects. You've enumerated some of them. Higher oil prices are another thing which we would point to, although those have happily come off somewhat. But overall, there still are some cyclical issues that we need to contend with. But I really think these are kind of more sort of speed bumps along the way. It's not something which will significantly derail the story, given the fact pattern that we have.
Okay, Tim, we leave it at that. Thanks a lot for joining in, and specifically on today, it's a big day for us. It's the 23rd birthday, so thanks a lot for being a part of our celebrations.
It's a tremendous pleasure, and thank you for having me.
All right, well, that's the word coming in from Goldman Sachs. With that, it is a wrap on this edition of Markets Today. Have a great evening.
CNBC-TV18, celebrating 23